In this session, let's look at the risk management from a corporate perspective. Typically, every company which is doing any kind of a business, there are some risks that are inherent into that particular business. It's any kind of a business. Probably we are talking about a manufacturing firm. There are some risks which are inherent into the manufacturing business. There could be a supplier problem. There could be a pricing problem. There could be a demand problem. There could be a lot of other issues. So in the traditional world, any business, there is some amount of risk that is inbuilt into that business. There is some amount of uncertainty that is inherent for any business. Now, they are very common in nature, and those uncertainties are giving rise to different kinds of volatilities in the earnings. To what extent those uncertainties exist, to what extent they are dangerous, to what extent they could eat away the profits of the firm, that is one thing that needs to be evaluated. But what we typically see is the business environment keeps changing every now and then. Competitive forces keep changing, new competitors get in, existing guys move out. So the competitive environment changes, the technology keeps changing, some new firms suddenly come out of the blue, whereas some firms completely lose their existence, and there are lots and lots of factors that impact and affect the suppliers. All these things are traditionally inevitable in any business. And what we typically see is companies do handle these kind of risks quite effectively as a part of their regular day-to-day operations. Though they may call it as business decision making, it's nothing but risk management itself. If you see anything to do with the suppliers, probably if they are really foreseeing that the raw materials may not arrive in time, or the cost of raw materials is going to go up, yes, they handle that risk by maintaining better inventory positions. If the prices are going to go up, they even try to mitigate that risk by entering into long-term contracts with the suppliers, which means they are doing risk management. Probably they may call it as the business decision making process, but what they are inevitably doing, what they are inherently doing is nothing but risk management. That is what is risk management all about. Understand the risks that are in your business, try to reduce them so that the volatility and the uncertainty is reduced and streamlining of the profits come up. In some cases, even the mergers happen to just cut out on the competition, right? It's a kind of a collaborative effort coming up so that the economies of scale can be worked out. All these are different measures of risk management itself. We may call them as strategic moves, but yes, strategy is again containing risk management as one of the major components in it. So today the risk management, and that too especially the financial risk management. When I talk about financial risk, we are not talking about the core business risk. We are talking about the market risk and the credit risk. How well the firms are able to handle these two risks is coming under the financial risk management category. It has become a very critical activity even if it is a non-financial firm. The reason being the disclosures that are coming up by the regulatory bodies, by the trading agencies, the disclosure requirement on the exposure of a company to various financial risks. To what extent the company is exposed, even if it is a non-financial company, to what extent it is exposed to market risk, to what extent it is exposed to credit risk is becoming very essential as a part of the disclosure. And that is again, the regulators are doing that because at the end it's the financial performance of the company that typically matters, and overall that is a part of the improvisation of the corporate governance practices of the firm. And we have seen that SOX compliance has become one of the major directives of the day in the United States, wherein a clear assurance is coming from the firm that all the internal controls, they are properly overseen by the CEO and the CFO of the firm, which means the senior management and the board cannot typically go away from the accounting mismatches and misrepresentations coming up in the financial statements. They become personally liable, which means there is a definite need in terms of they understanding the financing and accounting related entries that are going into the statements. And in some cases, even the risk management tools have been used for cooking up the financial accounts. So that's where a careful evaluation is very much required within the organizations. Now, a very interesting thing that is worth reading is, should the companies typically do a risk management exercise? A very interesting statement, right? A very interesting point to think about. Is it really necessary for a company to do effective risk management, to do risk management practices in place? There have been some kind of schools of thought or some kind of people who clearly talk about there is no benefit for a firm to do some risk management. The reason being, investors will do it at their end. Investor as such is a risk averse party, and because of the risk averse nature of the investor, he can diversify the non general risk. Specific risk can very well be diversified by the investor, so there is really no need for the company to typically diversify its risks or reduce its risk. And all this argument has stemmed up right 50 to 60 years back, when Modigliani and Miller, two major professors, they made this proposition saying a value of the firm cannot be changed merely by means of financial transactions. Any buying and selling related operations in the stock market are in by changing the financial structure, the debt to equity related structures, the value of the firm cannot be changed. It's a very exciting statement. The value of the firm cannot be changed by means of financial transactions. It could be changed by business operations, it could be changed by efficiency in the processes, all the other things. But just by doing a few financial transactions, the changing the debt to equity structure of the firm, you cannot change the value of the firm. But what we really need to understand is, when they have really come out with that proposition, they made it based on an assumption. Assumptions are very much necessary to understand the concept. They came up with that statement under the assumption that the capital markets work with absolute perfection. When we say absolute perfection, the irregularities may not exist in the market. All people are rational in terms of making their buying and selling decisions. So the capital market, any kind of mispricing that comes up, people are smart enough to take advantage of that mispricing. All these things suggest that the market is absolutely perfect, whereas the reality shows that lot of times the market is not perfect, which means there are lots and lots of irregularities that are there, lots and lots of instances which can show that the market is not perfect which means the on the other side now a new argument comes up. Yes, there is some advantage for the firms to manage the risk. But yes, let's first look at why there are so many theories that run around that there is no need for the company to manage the risk. The individuals can very well manage the risk by doing a proper diversification of their investments. Because they typically came out under this assumption, they simply made a statement investor can do the same. So the firm need not do it. And that same assumption has given rise to the world of capital asset pricing model. If you remember the formula for capital asset pricing model, the expected return on a security is going to be risk-free rate of return plus beta times the return on the market minus the risk-free rate of return. So the focus was only on beta, which is more of systematic risk, but there is no element of alpha, which is more of specific risk. So the company need not go about in terms of worrying about the specific risk. Investor will take care of it. Whereas the company should focus in terms of mitigating its systematic risk only. Any kind of project evaluation, any kind of investment decision the firm is going to take, it should base its decisions purely based on the systematic risk only, because the non-systematic risk can be diversified away. So very clearly it is saying that the firm should not engage in any risk reduction activity that the individual investors can execute. So in this case, because the individual investor can diversify those risks and create a portfolio for himself, because he is generally risk averse, he is willing to take a risk only if the expected return on it is going to improve. So because the investor is rational and risk averse, there is really no reason why they can't be why the firm should typically get into mitigation of that particular risk. That's a very interesting argument. We'll move forward and talk a little bit more about it or counter it slightly later. Another important reason that comes out is hedging is a zero sum game. It is really not increasing the profitability. It is really not increasing the cash flows. It is only reordering it. Probably sometimes it is coming early, sometimes it is getting delayed. It's only changing from time to time, but it's not an overall win-win kind of a benefit year over year. That's an important argument that people make. It's only changing the priorities. If we lose today, we may gain tomorrow. If we gain today, we are losing tomorrow. So it's purely a movement across different periods of time, but overall it is not a revenue increase or a cash flow increase exercise. And it is clearly said that using the derivatives, it cannot increase the value of the firm in a long term. And it says that self-insurance is a very highly efficient strategy, because when you are using derivatives in the external market, there are transaction costs, but when you are implementing self-insurance using your own strategies internally, there is no additional transaction cost that is boiling up. Another major argument that comes out, all these can't be discounted also. Active hedging, it distracts the management from its core business, because management now, instead of focusing on its core expense related activities or production related activities, it starts its focus more and more in terms of how to reduce the uncertainty or the risk. So there is a huge there is a huge distraction that is coming to the management from their core activities. And it's also said that risk management is not a simple exercise. It requires specific skills, specific knowledge, infrastructure, data, the tools, the softwares. A lot of things are required for implementing effective risk management. And small and medium sized firms typically may not have that skill in any form with them. So that's the reason they say there is no point in going ahead with a risk management plan. And a few set of people very cleverly argue that it is a double-edged sword, which it is. One, I can use the same for hedging purpose and the same can be used for speculation purpose. So if I don't understand for what purpose I am using, I'm actually bringing in more damage more quickly rather than remaining without using the derivatives as such. So they can reduce my risk, but at the same time, if they are not used properly, they can be leading to the close down of the organization, which we have seen in the last 1.5 to 2 decades. Lots and lots of firms across the world, they have shut down their operations, they have gone bankrupt, they have been bailed out purely because of the misuse of the derivatives. So that's one of the prime reasons, again, companies do argue that there is no need for them to do a risk management. And today, the disclosure requirements are becoming so intensive that almost all what they call as their proprietary aspects, they are getting more and more disclosed if they start using the derivatives. So they feel, what is the need for getting into the derivatives? If they have to, if getting into a derivatives make them mandatorily reveal their positions which earlier were fully concealed, now if they have to reveal them, their proprietary aspects are getting very badly impacted. That is where the companies have to be more and more careful of, and that is where different organizations come up with mechanisms saying that they are not interested in doing a risk management in place. But of course, all those things need to be taken with a pinch of salt. A few important things come out in favor of risk management. Now, there are a few who say, yes, the customer, the individual can diversify, but the probability of default, if a default is occurring because of the risk that is coming up, it can't be it can't be diversified by the investor. The cost of the default is very high. Bankruptcy costs are much higher. Doing a proper risk management is not for the shareholder, but it is primarily from the perspective of the company reducing its chance of default. The equity price may fall, the shareholder might lose, but once the company is going into a worse situation, the costs are going up, and a cyclicality is going to come up in it. The costs, okay, the default chances going up, lending is not available, new borrowings cannot happen, so new funds cannot get generated, existing assets cannot be sold off, the liquidity becomes a constraint, and all these things are added up to the heavy costs that are coming out of the bankruptcy. And just to reduce that kind of a situation, firms don't mind engaging in proper risk management activity. The other side we could look at as a kind of a mismatch between the management objective or manager's objective versus the shareholders. Every step the management is taking generally is in their own interest compared to the shareholders' interest. Now, they might not have a diversified portfolio. A shareholder might be having a diversified, but the manager is not having a diversified portfolio. So, really reducing the risk actually enhances the profile of the manager. So there is an incentive because he has reduced the volatility of the firm. He is getting an incentive because he is sending positive signals to the equity markets. He is getting an incentive because the returns are coming up consistently without much of an volatility. So the overall skill of the manager and the management as such is getting improved in the external market, which is improving the brand value of the manager, which is again adding as a positive to him. The volatile earnings, in some cases, they add up more and more to the taxation. The reason being, generally we see a kind of a slab based tax rate, right? And what could happen is if the earnings are very high, so they are getting taxed at a very high tax bracket. Earnings are very low in the next year, they are taxed at some other rate. But the tax rate here is much higher compared to this. Average of these two is always higher than the average tax rate that comes up when the earnings are at this level for both the years. So that is where we are saying taxation could be much higher if the earnings are not stable. So increasing in one year, decreasing in the other year may lead to overall high amount of tax that is being paid rather than consistently stable kind of earnings. That's also could be one more motivation for an organization to implement the risk management practices in place, use derivatives, and much more than that, a proper risk management practice will bring control over the objectives and measure them with respect to the performance. And looking at purely from the internal business perspective, the more and more proper risk management practices are in place, the cost of the firm are very much stabilized. The revenues of the firm are very stabilized because the pricing policy is very much stable. That gives a kind of competitive advantage over the nearest competitors, which is going to improve the brand value and then the share price of the firm. As simple as that. And one interesting point which I have come across is, see, for a lot of things, the companies typically take insurance policies. Probably their buildings they insure, and for vehicles they take the insurance. Now there are so many such kind of things for which the companies insure. They pay premiums, and the risks will occur only very rarely. When loss occurs, obviously there is some amount of loss mitigation that is coming up because insurance company is replenishing the losses. But overall what you see is on each of these things, the company is generally paying an insurance premium year over year, and the loss may not occur at all. So probably the premiums, whatever are being paid, they are looking like a cost which is not resulting in any benefit. But no one is typically questioning why the company is taking an insurance policy at all. But when it comes to the reduction of the financial risk using the derivatives, everyone start questioning. In reality, there is no difference between these two. You are trying to reduce your risk by transferring it to someone else who is willing to take it. Insurance company is willing to take your building risk. Insurance company is willing to take your vehicle risk. That's the reason you have transferred it. Similarly, if there is a third party instrument which is willing to accept your market risk, why not transfer it? So this is the change that has to come in the mindsets. And regularly on regular basis, well, now we see that companies really want risk management because they want to reduce their cost of capital. Overall, any kind of derivatives or any kind of hedging activity is going to reduce the risk overall. The overall risk measured in terms of standard deviation or any other measure, it's going to get reduced because because of volatility getting reduced, the risk is getting reduced, which means the cost of capital is also getting reduced. Companies would be comfortable in terms of raising more and more capital at much lesser cost, which can really help them expand their business, make more profit. So risk management is becoming more helpful there. And as we have already discussed, the capital markets are not fully perfect, which means the investor will not be able to do the diversification all by himself. What we typically see is there are so many places where the company has more information. There is a lot of information efficiency. The company has more information compared to that of the shareholders. So there is an advantage if the company does the risk management rather than shareholders trying to do that. That's one more important argument that goes in favor of the risk management. So these two arguments keep doing rounds across the industry. So which way we are going to take entirely depends on the organization and its management. Now comes another interesting aspect with respect to the risk management. How do I look at the hedging of the operations of the business versus hedging the positions on the balance sheet? When I'm talking about the hedging the operations, okay, when I want to reduce the uncertainty with respect to my income statement related elements, profit and loss statement related elements, like cost of raw materials. So any kind of mitigation that is being done towards the operations related, either it is in terms of expenses or in terms of revenues, anything that is being done, it will really bring about a competitive position to the company. It adds to the competitive advantage of the firm. It can add both in terms of size as well as the price. I can bring out a consistency in the pricing, which becomes an advantage. I can try to go for larger profit, which can add up to my overall benefit. So, whenever something is coming out with respect to hedging on the operations, companies should go ahead in terms of going about it, because it lies outside the scope of the CAPM model. We are not looking at the assets and the liabilities of the firm. It is within the internal, nothing to do with the market related operations. So there is nothing called perfect capital markets assumption that is applicable to it, which means the company should concentrate on reducing the risk that is coming through the operations. Anything that is going as a part of the profit and loss, it's better that it hedges those kind of risks, because they really improvise the profitability of the firm. They are not market related operations. And it's a very good saying that that kind of risk should be reduced, because it brings consistency in the production process as well as in the sales process, and it is very much advisable. It's nothing to do with the markets, it's nothing to do with the CAPM model. And one more important statement regarding the same is companies should concentrate on those business areas where they have comparative competitive advantage, and they should really move away from those areas where they don't, where they can't add value. And when in case we are looking at hedging a balance sheet position, which is hedging a financial position rather than a financial operation, if the capital market is perfect, it need not be hedged at all. But if it is not perfect, yes, look at the economies of scale. Are we able to get some kind of a benefit because of more access to information than the typical investor? Then go ahead into the hedging activity if it is a balance sheet based. And whatever the activities they are doing, it's better that they communicate the same to all the stakeholders. So just a quick information for you: any activity that is going to go into the income statement, P&L statement, it's better that they hedge it if they are not able to handle it. Whereas anything to do with the balance sheet, they can really understand it before getting into the hedging process. But yes, for every activity, proper risk management needs to be defined. And let me tell you, deciding on not to hedge is also a risk management activity itself. So the firm has to be really strong in terms of understanding which risk to accept, which risk to hedge, the price that it is going to bear and is going to incur in case it is transferring a risk. All these things need to be well understood and communicated to all the relevant stakeholders in the process. Now, looking at how to put this entire risk management into practice. Initially starts off with determining of the objectives. The objectives should be clearly defined in terms of risk and return. See whether the objectives are more specific to the firm or very general. General issues like, yes, targeted debt rating, or it could be like volatility measured in terms of standard deviation, not more than this much. So some kind of objectives can be more and more general in nature. Some of them are more specific to the business that the company is into. It really needs to evaluate. Yes, is our intention more and more to smooth out the profits, smooth out the costs and the losses, and to what extent we are ready to incur cost to typically smoothen out the profit. That is where we can perform a cost benefit analysis. Is it really worthy for us to look at risk management at all? And once they have really planned out, the next thing that they need to look at is the time horizon for this risk management. Are we going to reduce the risk within the next 2 months, or is it going to take a couple of years? And over what time period we are going to reduce our risk? The time horizon needs to be planned at the beginning itself. The liquidity related issues, the accounting related issues, tax related issues, all of them need to be very clearly understood before designing a strategy. Come out with a clear cut plan as to what risks would be hedged, what risks would be left unhedged, what risks we would be taking insurance for. A clear understanding of the various categorizations is very much required. How do you measure how effective was your hedging strategy? So there should be a proper mechanism for measuring the same. It has to be defined right at the outset, and even the risk limits, which are based on the risk appetite of the firm. The risk limits for individual department, business units, and types of risk need to be defined, which clearly send signals that these particular risks within this particular limit is allowed, and anything beyond it, the appropriate action need to be taken. So this is an entire step one where the objective of the entire risk management exercise need to be clearly documented by the firm. Then once they document, they go into identification of all the risks, and they have identified all the risks. They are mapping it. Business risk, market risk, credit risk, operation risk, and for each of the risks, try estimating the current and the future magnitudes. What is the probability of the occurrence of that particular risk? What is the severity of the occurrence? And overall, what is the kind of expected loss for each of the various types of risk? Because the company really need to differentiate between the risks that are getting insured by transferring it to the third party, the risks that are getting hedged by doing appropriate instruments in the financial markets, the risk that it is typically absorbing. A clear cut differentiation of all of them should be existing. Then once it knows that these are the risks for which the hedging needs to be done, these are the risks for which the risk transfer to an insurance company needs to be done, that is where it is searching out for the appropriate instruments available. In some cases, they could be managed in a natural way. The investment in one security versus second security, they can act as a natural hedge. If the value of this falls, the value of this goes up, and vice versa. This is like a natural hedging where we are not looking on the external market at all. So first point is, see if some kind of risk can be reduced internally through a portfolio kind of a mechanism. By creating a portfolio of risks, is there a way out that the overall risk exposure is reduced? If that is possible, implement that as the first step, because obviously that is going to reduce the overall transaction costs. Then next, look out if there are any kind of insurable risks. Any kind of insurable risk present, identify how much is real, is it really going to cost to transfer the risk, which means what is the kind of a premium that is involved in that particular process. Look at the cost benefit analysis, see whether the cost that we are paying is much more compared to the benefit claimed or vice versa. If that's the case, sometimes self insurance can also be looked at internal based. And even when there are various derivative contracts that are available, just try evaluating which one is a better suit. Is it an exchange traded derivative and an OTC derivative, over the counter traded derivatives? Both of them have their own advantages and disadvantages, right? You can read through any simple reading on derivatives, the differentiation between OTC based derivatives and exchange based derivatives. You'll see the benefits and the disadvantages that are associated with each one of them. So a company can very well evaluate which one better suits to the requirement and typically implements the same. Then comes identifying the strategy, building the strategy, and implementing it. This is where it can choose, it can try, first of all, data collection, whatever the data internal that is available. The CFO needs to have a good understanding and a good database of all of them, and any kind of pricing models, risk mitigation models, whatever are available in the market, they can be understood, visualized, and even if required, the purchase of them can very well happen provided the objective is getting met through the externally available tools. Otherwise, some kind of focus should go in terms of customized development of the same internally. Another strategy concern is the static versus dynamic. Should we just go for the hedging instrument once, and should we go for the hedging instrument that matches the risky position just once and don't rebalance it, maintain that position as long as the risky position is existing, or we are changing this position on a dynamic basis? The moment the value of the risky position changes, either increase the hedged position or decrease the value of the hedged position accordingly. Are we going to do that kind of a mechanism? That is what is a dynamic hedging, which involves buying and selling of the hedged instrument at quite frequency intervals of time. So the number of trades, the cost of transactions, all of them are going to go up in a dynamic hedging. So which one really suits to the requirement? To what extent, static versus dynamic strategy is really applicable? Very much need to be evaluated by the risk managers and the team within the organization. Again, the time horizon, should it be a fixed or is it rolling? Fixed means yes, I'm hedging it for a 2 year period. Or is it like first I'll do the hedging for a 3 months, then I'll roll it over for another 3 months, and that's how I'll go for a 2 year. Stack and roll. What is the typical mechanism the company would? Each one again has its own set of benefits and risks involved. So again, I look out on what is an appropriate strategy. And at the same time, there should be a continuous lookout for the potential accounting issues and the tax implications before deciding on one single strategy. And finally, it goes with the evaluation of the performance on a regular basis, just trying to see to what extent the overall goals are achieved. It's not majorly targeting towards whether there's any specific transactions have made a profit or loss. It is more to play with the volatility, to what extent the uncertainty and the volatility is reduced. If the risk manager is successful in doing that, the performance is good. Otherwise, it might be a possibility that the company might change the policy and come out with a new mechanism altogether. So the overall evaluation comes up, one, in terms of to what extent the risk related goal has been achieved by the risk manager, and at the same time, what is the cost that he has incurred in coming out with that objective. Because there is always a budget that is typically allotted to the risk manager. By what extent he has stuck to it, or by what extent he has exceeded that budget, even that is a performance parameter. All these things should really be evaluated when getting into the risk management aspect within a corporate. A company really needs to look at all these dimensions for successful implementation of the risk management to give it to give a core competitive advantage in the market, right?